We're very much moving into the valedictory remarks now, so I'd like to give you a minute each just to sum up your observations on the industry and the influence of quant techniques. I'd like to start with Professor Haugen. Bearing in mind your central premise that low-risk stocks potentially trigger the highest returns, why are so few active managers outperforming, if it's as simple as that?
Well, I talked about the volatility drain phenomenon, that over long-term periods, multiple periods, low-risk portfolios have a higher median average return, not a higher arithmetic return, but a higher median average. But I think there's another reason, and I think it has to do with the fundamental agency problem that exists in the investment management business. Several years ago, many years ago actually, I was asked to go on a tour of the United States by First Interstate Bank Corp. They wanted to find out what their managers were doing. So they asked me to go around the country, going to these offices and watching the process. And I had deep access because First Interstate Bank was a huge client to these managers. And I went into rooms like this with tables like this and people like this around the tables, and I watched them. And there was the chief investment officer at the head of the table, and then the analysts were around the table. And the analysts basically had to come and make a case for their stocks, each specialized generally in an industry or sector. And they came and they presented the cases for the stocks that they wanted to be included in the firm's portfolio. And it was a very intellectual discussion, very competitive. Lots of egos were involved. And you can imagine what would happen if week after week at the investment committee meeting you failed to make your case. Well, you'd be out the door. So these people had a preference for certain kinds of stocks. And these were stocks that were in the news. These were exciting stocks, intriguing stocks, stocks that people were talking about, writing about, stocks that were on television, on the radio. And to a great extent, their cases came from plagiarization of these stories. These are story stocks. Well, story stocks tend to be volatile stocks. And what I saw is that investment managers have a preference for volatile stocks. These people were all subjective managers that I went around looking at. They didn't even know what a standard deviation was. There was no volatility management going on. They wanted to be at the head of the table eventually. They didn't want to be out the door. So they were driven toward these stocks, and I think in the business, the prices of these kinds of stocks, volatile stocks, gets driven up. And they have lower expected returns. And that, I think, is one of the reasons why professional managers have a difficult time outperforming the market. Because the kinds of stocks they want, because of this agency problem, tend to be more volatile and tend to have lower returns.
I would say that this is a very good moment to create and sell quantitative products, not only to the institutional world, but also to the retail. We are a good example of that, especially if you can combat fears of black box investing simply but not being a black box. This is very important for the retail. Maybe is even more important for the retail than for the institutional, being able to have some reasonable framework that is understandable, but it's quantitative and can be reliable and independent from the single manager that can leave a company. The model won't leave the company.
Adam, you're the classic poacher turned gamekeeper. You used to create these things and sell them, and now people try to convince you to buy them. What would your conclusions be?
Yuri is referring to my history at JP Morgan for 24 years. And 10 years ago, co-founding Lord North Street, which is a private investment office. By definition, our clients are broadly private individuals or trustees, and everything in investment is quantitative. 2 plus 2 is investment is quantitative, and LTCM is quantitative. So you have to make a judgment at some stage about the big things, and the big things and the human things are the most important, particularly for private individuals as opposed to pensions. They need to be orientated in terms of how can the market serve the purpose of their money. So what's the money for? What's their level of understanding? What expectations do they have? And in many cases, they're not very sophisticated. Or in many cases, it may be a group of trustees around a table with very different concepts that need to be brought together around the big decisions, which are, as we've been discussing, asset allocation first and foremost, and then the question of what's your tolerance and how long can you live with that and how do you express it and how do you do a bit better in each asset class. So for our kind of clients, beginning with the big decisions and matching their expectations and gauging their level of understanding is the right thing. So you go down the sequence of the big decisions of asset allocation strategically and then tactically, and then manager selection and understanding what you bought and why you bought it, and then importantly adapting, both managing your client's expectations but also explaining what's going on. And in many black boxes of quantitative products, explaining what's really, really going on is difficult. And the test of that perhaps is the quantitative models that worked 10 years ago or 5 years ago are not necessarily the ones of today. So what are the ones of tomorrow? They involve judgment. So I don't think one should put too much faith in single ideas and quantitative boxes.
Well, many thanks to all of you for your astute opinions, observations and evaluations of quant strategies. I'm afraid there's not much that I can add to this discussion, but the Professor of Finance who supervised my very amateurish observations on investment many years ago was certainly no believer in active management at all. He said that, like marriage, it was a triumph of hope over expectation or reality. He believed there were very few circumstances in which active managers could outperform what he believed was a highly efficient market. So perhaps it's time for that orthodoxy to be put to the test. Thanks very much to all of you, and hopefully there'll be many more discussions like this to come. Thank you.
Thank you.